Today we're going to talk about franking credits or imputation credits, what they are, how they work and how they can benefit you. Franking credits are a tax offset available to Australians who receive dividend income from Australian-based companies. Generally blue chip companies such as BHP, Telstra, the banks all attach franking credits to their dividends, although other companies can as well. Now, whether you own shares through a managed fund or directly, the franking credits should actually flow through to you in whatever structure that is. The Keating government introduced franking credits in 1987 as a means of avoiding the double taxation of company profits. So essentially what was happening is a company would earn some money, the ATO would tax them on that, they'd then pay that money to their shareholders as a dividend, and the ATO would then tax that money in the hands of the shareholders. So they'd be hitting the same dollar twice. So how that would look is the company would earn $1, they'd pay a company tax rate of 30%, which would leave 70 cents. That would get paid as a dividend to your shareholder down here. They'd receive their 70 cents. And let's say they were on a marginal tax rate, a personal tax rate of 30%. They'd then get charged 30% on 70 cents, leaving 49 cents as the final dividend after tax. Obviously, it's a bit of a problem because you've had your dollar get chomped down to 49 cents because of double taxation. So the way franking credits are designed to work is to rebate the shareholder for that 30% that the company paid. So now the way it works is company earns $1, they pay their company tax of 30%, leaves 70 cents. That 70 cents is a dividend, and it'll also come with a franking credit of 30 cents, which was the company tax that was paid. That will go to the shareholder and grossed up will be $1, 70 cents plus 30 cents. The shareholder will pay their marginal tax rate of 30 cents on it, taking the dividend down to 70 cents, but this franking credit or tax offset will come in and add another 30 cents in the tax return because it's a tax offset, bringing the dividend back up to $1. So what we have here is the effective rebate of the company tax that was paid. How is this advantageous to you? Well, obviously it means you pay less tax on the dividends that you earn. If you on a marginal tax rate of 30 cents, then your tax liability for that dividend is wiped out completely. If you're on a higher tax rate, it's reduced. Now, if you're on a lower tax rate, say you're on a 15% tax rate, the good thing about franking credits is that any excess franking credits can actually be returned to you as a cashback in your tax return. So you can actually increase your dividend and make money on the tax that you didn't pay, but the company tax did, in excess of your marginal tax rate. This is great for things like super funds, self-managed super funds, in order to enhance or boost your income from the dividends that you get. Now, it's pretty important to obviously recognise that whilst dividends and franking credits applied to dividends are a bonus or an extremely good feature for paying less tax, they shouldn't be the main or primary concern as to whether you invest into something or not. Ultimately, with an investment, you want it to be have sound research, sound fundamentals behind it. The franking credit really just needs to be an addition or a bonus.